You can feel it when the room splits in half. Half the people are staring at gold like it's the only honest chart left, like it's the real signal, the adult in the room, the thing quietly telling you what the system won't say out loud. And the other half are staring at silver like it's the opportunity, the sleeping giant, the thing that moves harder, faster, and makes people believe they can catch a life-changing wave if they're early enough. And that's when the danger shows up. Because when everyone is trying to decide which metal is the real signal, most people end up doing something much simpler and much more expensive. They confuse a signal with a trade, and they confuse a trade with a story. So today we're going to settle this in plain English. Gold versus silver today. Which one is the real signal, and which one is the trap? And I'm not going to give you a neat one-line answer like buy this, sell that, because metals don't work like that in real life. They work like a tug-of-war between psychology, liquidity, and the rules of the market. What I will do is show you how to read them like a grown-up, what gold tends to signal, what silver tends to exaggerate, how they can diverge, and the exact behavior patterns that tell you when one of them is warning you and the other is baiting you. Quick check-in before we start. Comment one word, gold or silver. Not which you like, which one you're watching more closely right now. One word. Then we move. Okay, here's the first idea you need, because it's the foundation of everything else. Gold is primarily a confidence signal. Silver is primarily a volatility amplifier. That doesn't mean silver can't be a signal, and it doesn't mean gold can't be a trap. Both can be true, but in most regimes that's the core difference. Gold is the market's lie detector. Silver is the market's mood ring. Gold tends to move when trust, currency dynamics, and real rates are shifting. Silver tends to move harder when speculation, liquidity, and positioning get crowded. And because silver is smaller, thinner, and more leveraged, it can turn a normal narrative into a knife fight. Now let's slow down and define what we mean by signal and what we mean by trap, because people use those words like memes. A signal is information you can build a framework on. A trap is a move that looks like information but is mostly positioning and emotion. Something that pulls you in and then punishes you, not because your long-term thesis is wrong, but because the path is designed to harvest impatience. And the metals, especially silver, are famous for harvesting impatience. Now, why does gold get treated like the real signal? Because gold isn't just a commodity. It's a monetary asset that happens to look like a commodity. It's held by central banks. It's held as a reserve. It's treated as insurance. It's a hedge against the unit of account wobbling. Gold is what people reach for when they want exposure to something outside the promise stack. That's why gold often behaves like a macro indicator. It's sniffing the air for policy credibility, currency risk, systemic uncertainty, and the long-term value of money. Silver, on the other hand, is a hybrid. It has a monetary story when people get nervous. It has an industrial story when the world is building. And it has a speculation story when the crowd gets excited. That third story is what makes silver both thrilling and dangerous. Because silver can move like a monetary asset one week, like an industrial commodity the next, and like a meme the week after that. And if you don't know which mode silver is in, you will misread it constantly. Now let's talk about how each metal behaves when it's being honest. Gold is being honest when it moves steadily, with follow-through, and doesn't need constant hype to keep going. Gold is being honest when it's strong across currencies, not just in one currency. Gold is being honest when it rises, even when the news cycle is quiet, because it's reacting to underlying conditions, not headlines. Gold is being honest when it doesn't overreact to every intraday wiggle, but grinds and holds. That type of movement is usually telling you something in the background is shifting. Maybe it's real rates, maybe it's policy expectations, maybe it's currency volatility, maybe it's demand for collateral like safety outside fiat, but it's usually not pure retail emotion. Silver, when it's being honest, doesn't necessarily move calmly. Silver's honest can still be loud, but the tells are different. Silver is being honest when physical demand stays resilient and premiums don't collapse on dips. Silver is being honest when it follows gold's direction, but with healthy pullbacks, meaning pullbacks that don't immediately trigger cascade selling. Silver is being honest when it rallies and then consolidates rather than instantly reversing in violent whipsaws. Silver is being honest when the move feels like accumulation, not stampede. Now here's where the trap begins. Gold can become a trap when people treat it like a short-term momentum toy. Because gold can chop sideways for long periods. It can grind. It can frustrate. So if you buy gold expecting instant fireworks, you can get chopped into bad decisions. Not because gold is broken, but because your time horizon doesn't match the instrument. Gold's trap is boredom and impatience. Silver's trap is excitement and urgency. Silver is the market that spikes to make you chase and dumps to make you regret. It is built to punish urgency. Now I want to show you something that will help you read which one is the real signal in real time. Watch the relationship between gold, silver, and the dollar. Not because dollar down, metals up is always true. It isn't. But because the interaction tells you what regime you're in. When gold is rising while the dollar is stable or even firm, that often implies gold is being bought as insurance, not just as a currency trade. That's a signal. When silver is rising faster than gold while the dollar is stable, that can mean speculation is ramping, risk appetite is pushing, and positioning is getting crowded. That can be a signal too, but it's a different kind. It's not a system is breaking signal, it's a crowd is arriving signal. And crowds can create both opportunity and traps. Now let's talk about leverage, because leverage is the invisible hand behind most silver pain. Silver is easier to whip around with leverage because the market is thinner, and the products are built for it. And in leveraged markets, volatility doesn't just reflect emotion, volatility changes the rules. When volatility rises, margins rise. When margins rise, some participants are forced to sell or cover. Forced selling creates more volatility. More volatility creates more margin pressure. That's a feedback loop. And this is where silver becomes the trap, because silver can be fundamentally bullish and still crash in the short term due to forced liquidation. Silver can have strong physical demand and still get slapped down by paper flows. That disconnect confuses people. They assume if the story is true, the price must behave logically. No, the market doesn't have to beat your thesis. It only has to beat your position size. That sentence matters more in silver than almost anywhere else. So if you're asking which one is the real signal, the next question should be which one is more likely to reflect the background conditions, and which one is more likely to reflect positioning and forced behavior. Gold more often reflects background. Silver more often reflects positioning. Now that doesn't mean gold always signals truth and silver always lies. Gold can be wrong too. Gold can be delayed. Gold can be influenced. Gold can be driven by flows that aren't macro insight. But if you want the cleaner signal about the system, policy credibility, real rates, currency risk, gold is usually the first place to look. Silver is the place you look to see whether the crowd is turning that macro signal into a volatile trade. Now let's make this really practical. Here are the signs gold is the real signal today. 1. Gold is holding gains, not just spiking, holding. 2. Gold is rising across currencies, not only in dollars. 3. Gold is strong even when risk assets feel unstable or correlations get weird. 4. Gold's move is steady and persistent, not constantly reversing. 5. Gold is acting like insurance, not like a meme. If those are present, gold is likely telling you something about the system. Now here are the signs silver is the trap today. 1. Silver's daily ranges are expanding dramatically. 2. Silver is making frequent intraday reversals. Big up candles followed by big down candles, or vice versa. 3. Rebounds are failing quickly. Bounces get sold within hours. 4. You see air pockets. Sudden drops that feel like liquidity vanished. 5. Commentary becomes euphoric and urgent. Everyone starts talking in absolutes, targets, moon guaranteed squeezes. 6. Leverage conditions tighten, margin hikes, platform restrictions, spreads widening. That cluster is the trap environment. Not because silver can't go higher, it can, but because the path becomes hostile, and hostile paths destroy weak positioning. Now here's the twist. Silver can be the real signal too when it diverges from gold in a specific way. If gold is stable or rising modestly, and silver is consistently strong without chaotic whipsaws, that can signal something important. Industrial demand expectations are improving, or physical tightness is becoming meaningful, or investors are rotating into higher beta hedges. In those regimes, silver strength can be real, but it has to be the right kind of strength. Not the 3 energy drink strength, the follow-through and consolidation strength. Now let's talk about which one is the trap from the opposite direction. Gold becomes the trap when people assume gold must always protect them immediately. In sudden liquidity events, gold can get sold too, because when people need cash, they sell what they can. In a liquidation cascade, gold can dip even if it's the hedge, because the hedge becomes the piggy bank people smash to cover losses elsewhere. So gold can trap people who think hedges are magic. Hedges reduce risk over time. They don't guarantee you'll never see red days. So if you buy gold thinking it's an on-off switch that instantly protects you, you can panic on a pullback and make it useless. Gold's trap is misunderstanding its job. Silver's trap is misunderstanding its violence. Now I want to give you a simple way to use both metals as a framework. Think of gold as the compass. Think of silver as the wind. The compass tells you the direction of the broader environment. The wind tells you how rough the ride will be. If gold is rising steadily, the compass says increasing demand for insurance, or decreasing confidence in the unit, or falling real rates. If silver is rising wildly, the wind says speculation is arriving, leverage is building, volatility is going to punish impatience. If gold is flat and silver is exploding, that can be wind without compass, often a sign of a speculative surge that can reverse quickly. If gold is strong and silver is weak, that can be a signal too. Risk appetite may be cautious, industrial expectations may be soft, or the market may be buying pure insurance rather than high beta. Now let's address the most common mistake people make when they try to read gold versus silver. They assume one must be right and the other must be wrong. Sometimes both are right. Sometimes both are wrong. Sometimes one is early and the other is late. The market is not obligated to give you a clean narrative. So instead of asking which is right, ask which is reflecting structure and which is reflecting emotion, which is steady and which is fragile, which is being accumulated and which is being chased. Now let's talk about retail, because retail behavior can turn silver into a trap faster than people realize. Retail doesn't need to be the biggest buyer. Retail just needs to be the loudest accelerant. Retail attention increases the speed of the narrative. Narrative pulls in speculative flows. Speculative flows add leverage. Leverage creates fragility. Fragility creates cascades. That's how silver turns into a volatility loop. And the volatility loop is what makes silver feel like a trap even when the long-term story is intact. Now here's the one rule that saves people in both metals. Don't let your position size turn you into an emotional hostage. If a move ruins your sleep, you're oversized. And if you're oversized in silver, you're playing with gasoline near a flame. If you're oversized in gold, you're turning a hedge into a stress source. Reduce the size, and suddenly your decision-making improves. You stop chasing, you stop panicking, you become unforced. And in markets, unforced is power. Now I'm going to give you a simple scenario tree to answer the title in a practical way. Scenario 1. Gold leads, silver follows calmly. That's the healthy regime for metals bulls. Gold is the signal, silver is the amplifier. But the amplifier is not screaming. You often see this when the macro backdrop supports hedges and liquidity is not collapsing. Scenario 2. Gold leads, silver lags or chops violently. That's a caution regime. Gold is signaling insurance demand, but silver is telling you the path is fragile. This can happen when industrial expectations are uncertain, or when leverage and paper flows are dominating. Scenario 3. Silver leads with chaos. Gold doesn't confirm. That's often the trap regime. It can still go higher, but it's the regime where crowd emotion is driving the move and reversals can be brutal. Scenario 4. Gold spikes, silver doesn't respond. That can signal pure fear hedging, or a lack of risk appetite, or a market that wants safety without beta. Now how do you identify which scenario you're in? You watch follow-through. Gold follow-through tells you whether the signal is persistent. Silver follow-through tells you whether the wind is controlled or stormy. You watch intraday reversals. You watch whether dips get bought and held, or bought and immediately sold. You watch whether spreads widen. You watch whether leverage conditions tighten. All of these are clues. Now because everyone wants a clean answer, I'll give you the cleanest practical rule I know. If you want the real signal, prioritize the metal that is moving with persistence and calm relative to its history. If you want to identify the trap, look for the metal that is moving with urgency and fragility relative to its history. Most of the time that means gold is the signal and silver is the trap when silver becomes chaotic. But in some periods gold can be the trap if people expect instant protection, and silver can be the signal if it's rising steadily on genuine demand without unstable leverage. Now let's close with the question you should be asking yourself today. Are you trying to be right about the next move, or are you trying to survive the next move? Because metals are not only about direction, they're about path. Gold's path can be slow and frustrating. Silver's path can be violent and punishing. If you choose the wrong tool for your time horizon, you will feel like the market is unfair. It isn't unfair. It's structural. Gold is the compass. Silver is the wind. Use the compass to understand the environment. Use the wind to manage your exposure. One final prompt, and I'm keeping it to one. Which one do you think is the real signal right now, gold or silver, and why in one sentence? If this helped you, subscribe. I'll keep breaking down markets in plain English without the hype, because most people don't lose money from being dumb. They lose money from being surprised. Educational only, not financial advice. I don't know your situation. Nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and stay unforced.